Hello, it's Adil bringing you a review of the US markets from an intermarket analysis perspective. Obviously, the week commencing the 1st of December 2014. Okay, so I've already done my review on the European and UK markets. Okay, so the bias remains bearish there. So, based on intermarket analysis, that must presume or must uh, put forward an argument for the US markets to obviously move lower as well, just based on intermarket analysis, given the fact that they're all interwoven and intertwined. Okay, so let's see what the arguments are. Okay, with regards to the US markets. Okay. Last week, the economic data out of the US overall was relatively bearish. Okay, it wasn't exactly spectacular. Okay, with regards to the economic data there. Now, all you must remember that taper is over. Okay, so given the fact that there's no QE, etc., in this market now to propel it, QE4, obviously comments have certainly been laid to bed as well via Bullard. So therefore, there's no real QE or central bank put left other than the fact that you're hoping on the fact that interest rates are going to be prolonged, interest rate hikes are going to be prolonged for longer. Okay, so that's certainly an argument. So really, the economic data is what the US market will be relying on going forward. So the concept of bad news equals good news and good news equals bad news really has certainly lost its shine. Okay, and certainly will not. I mean, it will to a certain extent because obviously interest rates expectations are pushed back to a large extent. But how much of an effect do interest rates really have on the economy? And so really it has to, given the fact that it's off the morphine now, i.e. no more QE, Kool-Aid, etc., has come to an end. This patient, okay, that's according to the Fed, they expect it to survive by itself and obviously resuscitate itself now, okay, because it's off the life support machine. Can it rejuvenate itself? Okay. So it's all about photosynthesis. So it needs the correct amount of light, the correct amount of water, etc., etc., and needs to be nurtured properly. So that's basically the question that everybody's asking, and that's not the case, because the economic data that came out last week itself wasn't obviously supportive or wasn't supporting the arguments or supporting the viewpoint of the Fed to a large extent. Okay, so if you just go through last week's data, and you'll see there's a lot of misses. Okay, and a lot of concerns as well, especially with regards to the inflation picture as well. So it's very interesting. So from my perspective, the overall weak economic data last week, okay, number one, and a lot of it was ignored given the fact that it's light volume and obviously the manipulation going into Black Friday, etc., etc. And I've certainly touched upon that. Now we've got anti-QE comments from Europe. We've got budget concerns in Europe. Okay, the Russia-Ukraine situation certainly isn't laid to bed. Okay. We've got the commodities crash. Obviously, that itself can trigger off a sell-off in the stock market, given the fact that hedge funds are obviously exposed and may well get margin concerns, etc., etc. I mean, there's a lot of arguments there, but overall, obviously, S&P 500 is heavily weighted towards commodities as well. Okay, don't forget ExxonMobil, Chevron, etc. So obviously, it will get hit from that perspective, even though there is a stimulative effect, i.e., lower oil, etc., can help disposable income and so on and so forth. And it's not a coincidence that they didn't cut OPEC didn't cut production in a Thanksgiving / Black Friday week, where obviously the retailers rely heavily or depend heavily upon the consumption pattern being very high. Okay, so it's all, I mean, I'm not saying it's rigged, but it's certainly orchestrated in a way that favors the US stock market. So that's going to be very interesting going forward. So the economic data isn't supporting the equities going higher. The concerns obviously we have with regards to China obviously slowing down, hence a rate cut. That's going to be very interesting this week. And obviously given the fact that Mr. Abe itself, the USD JPY is stuck at 118 and isn't really being propelled any higher. Given the fact that Mr. Arso said that the yen had obviously depreciated very quickly, and that's the reason why the Chinese have cut their interest rate, because they're concerned that they're losing exports to the Japanese. Okay, so there's a lot of games that are being played in the socio-economic background, and that's something that you'll have to read, and obviously you can base your trading decisions on that. But from my perspective, we have a weaker Europe, we have a weaker UK, and that obviously will have an impact on the US markets, given the fact that the volume picks up, participation picks up, and given the weak economic data last week out of the US, that will translate into lower prices. Okay, so that's basically the theme that we expect, and that's what we see. Obviously, given the Swiss vote itself is going to be interesting as well, seeing how that plays out as well. Okay, so now let's review the technical arguments now that we have the fundamental catalyst in place, and you have the intermarket analysis perspective as well, because the weakness in Europe and UK will obviously have a drag on the US as well. Okay, and obviously adding the fact that light volume is no longer a variable in this equation. Okay, so we should have some normalcy with regards to price action, not floating higher constantly without any rational or logical explanation, given the fact that it's all manipulated and they want the markets higher and everybody feeling happy and consuming as much as they can in this Black Friday sales. Okay, now let's have a look at the market. So the S&P 500, okay, weekly chart, we already know it's on a potential break, but we do have a doji on the weekly there, which is quite interesting. Daily chart, you have a bearish engulfing candle. That's not exactly a healthy sign. Okay, 60-minute chart on the S&P 500. We are still making higher highs and lower lows, higher lows, but it certainly looks a very weak argument from my perspective. Now you have this potential pattern that needs to be watched carefully. A higher rising, contracting wedge pattern is a bearish signal. You have an unfilled gap below. We have this key trend line here. We have two unfilled gaps below, and obviously an unfilled gap here. So the first gap that I'll be expecting from the outset is 2053. Okay, you have potentially a failed bull flag, because we've not had a real concerted move here. Friday's move, as you can see, was certainly weak. Okay, so that's certainly not looking good from that perspective. So looking for a potential move lower here and rising contracting wedge breakout on the downside. Okay, so let's have a look at the 10-minute chart on the S&P 500. As you can see here, it's made an intraday double top, rather than an intraday, a double top on a 2-day basis. Okay, really, other than that, there's no real diagonal trend line that I can draw from my perspective, and that's really all we can see right now. Okay, so looking at a potential break here, this is your left shoulder, you've put a potential head in here, we didn't get a right shoulder in essence. So really, from my perspective, it's break of a key diagonal trend line. Okay, we did go into this potential gap fill, well, almost went into this gap fill support, so that's one gap there. So the gap fill support on a short time frames 2063, watch out for support of 2063, and the next level to watch then will be lower, will be the 2052 level. This is just a diagonal trend line that's coming up, and this may well come into play as well. So early support levels 2063, gap level 2057, and then gap fill level 2052. So these are all levels that I'll be watching and looking for a potential move lower. As you can see, a bear flag formation is certainly in motion. You've held the 200 MA and looking for a short-term bounce on this gap level as well. That's certainly come into play for support, which is horizontal support as well. Okay, so the S&P 500, watch out for those gaps below. That's all I'm going to say from the S&P's perspective. So that we know that the setup on the S&P 500 is bearish. We can look at the Russell just to confirm that as well. Now Russell, I did highlight on Russell that the Russell has held its gap level for some time now. Okay, we held this back in November, and obviously we've held it again. It's quite a substantial sell-off. So that bearish engulfing candle, that double top or triple top resistance, whatever you want to call it, okay, the market has failed to make a higher high. That itself is bearish. Okay, if that's bearish, then obviously we know that that's been confirmed via the setup on Europe and the FTSE. I've already explained why that's bearish, etc., etc., and given the economic data that's come out of the US itself confirms that as well. So bearish engulfing candle with regards to the Russell. Okay, so the Russell is confirming the weakness on the S&P 500. This is very important for you to understand. Okay, now I don't think there's any real reason for me to go into the 60-minute chart of the Russell, given the daily chart is so bearish, but I can go into it anyway, and as you can see here, it's certainly looking at a very weak 10-minute chart. Again, I don't think I need to explain that. As you can see, quite a substantial sell-off on a Friday. So it's I mean, I'm not a conspiracy theorist, folks, but this itself will confirm that the last day of the light volume manipulated week going into Black Friday, the intelligent money is running to exit. That alone should explain everything to you. Okay, the smart money runs to the exit on a Friday. The game of musical chairs is up. The music stops, they know that, and they're getting out, and that's what you call smart money. Okay, so if you read smart money and you understand how smart money works and how it operates and how it and its characteristics, and you can spot it, okay, by doing intermarket analysis, then you'll always be ahead of the game. Okay. Excuse me. Let me just Yeah, sweet. All this talking, I think I've made 2 or 3 videos now, so this is the third one, so bear with me. Let's get sweet. Hopefully that will allow me to continue talking. Okay, so this is basically where we are now. Okay, so I've explained the Russell, I've explained the S&P, and how one or both can confirm the other. Okay, and vice versa. Okay, so generally it's Russell that will confirm, and you have a leader and laggard, and this is what I explain when I teach and do the mentoring course via intermarket analysis. Okay, now the next index that we look at is the Dow Transports. The Dow Transports generally tends to be the leader in this market, along with the Russell and along with the biotechs. And as you can see here, you have a topping tail. Okay. Now, the German DAX is the leader in Europe, and that has a hanging man. And the Dow Transports is one of the leaders in the US, and that has a topping tail. So what does that tell you? A shooting star, topping tail, call it what you want. Basically, all its candlestick is trying to tell you that is that we had a green candle, and the buyers lost control, and that basically means that the bears are back in control. There's exhaustion, and that's generally indicative of a reversal. Okay, that's basically it's telling. I mean, you can call it whatever you want. Okay, give it any posh term, any sophisticated name that you want. Okay, to make yourself sound clever. Okay, it's basically price action. Okay, keep it simple, folks. Okay, and 60-minute chart here now. Okay, so 60-minute chart, you can see you had a green candle initially. Green candle was negated, and now you're looking for a potential H&S scenario here. Your left shoulder head is already in, looking for a pop, bang, down we go. Okay, 60-minute chart certainly bearish. So given the fact that Dow Transports is bearish, what do you think will happen to the Dow? Obviously bearish. So you can see 10-minute chart, double top resistance has held. 60-minute chart will confirm that to you. Bull flag failure. This is very interesting, this, folks. The FTSE on the daily chart has a failed bull flag, which I've already explained in my analysis due to weakness in commodities. So that failed, and given the fact that the Dow and FTSE are intertwined to a large extent, and the movements between the two are very, very similar, a lot of individuals do use the Dow to trade the FTSE, etc., and vice versa. Okay, obviously it's not 100% correlation, but it's strong enough to obviously give you a confirmation bias. Okay, so you can see here double top, fail bull flag. What happens? Down we go. Okay, so on the daily chart as well, as you can see here, topping tail and a doji. Okay, so very bearish. Okay. Okay. Now let's have a look at the actual Nasdaq, which is very important. Okay, Nasdaq itself, a doji candle on a daily chart. Now the Nasdaq will have a lot of support for it because it operates in the obviously technological sphere, and it's all about disposable income, and that's what Nasdaq relies upon. Okay, because of TVs, videos, smartphones, etc. It's all about disposable income, and given the fact that oil prices are declining, Nasdaq will remain well bid regardless. Okay, so remember this. This isn't. I'm not calling for a major reversal in the Nasdaq. If there's any index that you want to be buying right now, given the social media boom and the drone boom, etc., which is the next potentially next big thing, drones. Okay, which every Tom, Dick, and Harry is trying to get into. Even GoPro is trying to get into drones now. Okay. Technology going forward will be a massive industry, and if anybody wants to seriously start to invest, and myself included, and I'm referring to myself here, technology definitely is the future and the way forward. Okay, I just think it's from my perspective. I mean, buying water companies and technology, any tech companies is certainly the way forward, and that's where the money will be going forward. And obviously agriculture as well, but I'm not going to go into too much detail. But generally the 3 areas that I love to invest in, and I am investing in, and I will continue to invest in. Okay. Right, 60-minute chart of this Nasdaq rising contracting wedge. The only concern, only bearish argument I have on this is the fact that we've carved out a potential H&S, and we need to close this gap below. Okay, once that gap's closed, after that I'll see exactly what happened. But for now, 4320, and we do have an unfilled gap at 4290 as well. So again, we'll see exactly what happens with regards to that scenario. but every other bearish pattern certainly has failed, and obviously the Nasdaq has continued to propel itself higher. Okay, so I wouldn't get too bearish on the Nasdaq, but certainly calls for a reversal. That can be cross-referenced and checked by the biotech index. The Nasdaq biotech index posts a doji, i.e. potential fake breakout, okay, or a fake out. 60-minute chart, obviously bearish engulfing candle. That certainly isn't a bullish sign. Certainly a sign that we need some short-term pullback, if that's okay. And potential pullback could be around here. I mean, we have had a bounce from there potentially testing this lower trend line. Looking for from a 60-minute chart basis. I mean, there's certainly an argument here for a H&S, but we'll see. Let's give it early days yet. Okay, early days. I don't want to be too bearish in the biotechs or the Nasdaq, but certainly calling for a pullback. Semicons remain solid on a daily chart. Certainly argue it's a doji on a daily chart. 60 minutes, certainly potential reversal or pullback. Looking at potential pullback. 10 minutes, certainly can't argue here as well at all. Like I said, it's all about higher disposable income via lower oil prices. Okay, so that's the important aspect here. Okay, now let's have a look at the other alternative indices that I generally tend to focus on. Russell 3000 weekly chart, certainly a doji. Daily chart, as you can see, bearish engulfing candle. 60-minute chart certainly looks like a potential topping pattern here, given the fact that we've failed to make a higher high. Okay, and we are in this zone here, so you've got resistance here, and looking for potential reversal on our cards here. So we have this rising contracting wedge pattern, and like I said, looking for a potential move lower, although one must be careful with regards to the patterns as well. But from this perspective, like I said, the light volume has obviously forced this higher, and we're looking for a potential reversal given the fact that we've got rising contracting wedge pattern breakout and a failed bull flag, and looking for a move lower. And as you can see here, quite a substantial sell-off with intelligent money leaving and exiting very quickly. Okay, Wilshire, again, like I said, you've got a bearish Wilshire 5000. This is another index I generally tend to track a lot. It gives me an overall understanding of the markets. Daily chart, bearish engulfing. 60-minute chart, failed bull flag, rising contracting wedge pattern. And 10-minute chart, like I explained, looking at double top intraday, triple top resistance, and looking for potential lower lows and lower highs from here. Okay, so that's basically a summation of the US markets from a technical perspective. You can look at the VIX. VIX certainly is potentially into support as well. Okay, and also with regards to the yen has made a double bottom. So if I just delete this for you 1 second and just show you, you've got a falling contracting wedge pattern here. You've got a potential double bottom scenario for support with regards to the yen. So we're looking at a potential yen move higher with regards to all these gaps up here. So once the yen has put in a bottom, that means that the bias is obviously a risk off. Okay, so yen moving higher. Okay, given the fact that the Swiss vote will obviously cause the French, also Swiss vote cause the Swiss franc to certainly move higher, and the yen will generally move higher with that. The euro will move higher as well because it's short squeezes, and that will put pressure on Europe. Europe and the UK will obviously come under already into resistance, or are certainly bearish from their technical and fundamental understanding, which I've explained already in my previous videos, and that itself will obviously add weight to these arguments that the yen will catch a bid due to risk off, and it has to close all these gaps above. Okay, and this is going quite deep now with regards to or reference to intermarket analysis, but that's just my thought process and my understanding, and that's basically how I trade based on intermarket analysis. Okay, folks, so this pattern here is very interesting on the FTSE, a failed bull flag, and I'm already short, like I explained, from 6, 7, 11 on a Friday, and looking for a gap lower. And I'll certainly be in the bearish camp, and I've put forth my argument, and that's up for you now to digest and certainly come to your own conclusion. Okay, folks, so risk on, risk off, wax on.